Hey guys, so I know it's been about a week since I posted a video, so I was thinking of video ideas, and I thought I would share just a tip that I could have used when I first started out investing. So when I first began my investing journey, I used to buy individual stocks, alright, which was not a good starting point. So I ended up buying a whole lot of PayPal, like you might have seen in my last video, and that was when PayPal was like 120 something dollars, okay, and now it's at 60 something. All right, so I just wanted to share this video in case anybody is just starting out like me, or when I was starting out, just avoiding that mistake. Don't put all your money into one stock. And this video is just going to be about my reasons why, obviously. So yeah, let's just get right into the video. Okay, so now that you can all see my screen, I just wanted to first of all thank you all for just the support on my channel recently. Looking here, we have 1,000 views on that first video, which is kind of crazy. All my other YouTube channels never did this well, especially in the first 2 weeks. So that's kind of crazy. And yeah, we got 10 subscribers now, so that's a pretty cool milestone, I guess you could say. But yeah, let's get right into the meat. Okay, so looking here, my first reason of why you shouldn't buy individual stocks is because only a select few stocks lead the S&P 500 every year. Okay, so looking at this graph, this is a graph of every company in the S&P 500 since last January, so year to date. Now looking at the performance, so you can see it's only been about 10 or 20 stocks that have led the S&P's gain this year. So it looks like we got Meta, Nvidia, AMD, RCL, Salesforce, Tesla, your large cap tech stocks. So you pretty much had to be buying large cap tech stocks in the beginning of the year to make money. Everything beyond here, you're underperforming the market essentially, and anything beyond here is you're negative, you're losing money. So it's just best in this case to stick to an ETF if you don't know what you're doing. All right, so looking at the formatting here, looking at the plan, I guess you'd say. The next point is that companies can have issues that are only specific to themselves. Okay, now what I mean by this is that a stock like Pfizer or Johnson & Johnson could have a drug patent that didn't get passed along the product's pipeline or something like that, and that could cause the stock to drop just based off of an approval of a drug or not. And that only applies to one stock. So for example, Johnson & Johnson could go down 5%, but the rest of the pharmaceutical sector of the S&P could be actually going up because that drug approval doesn't apply to any other stock besides Johnson & Johnson. Okay, so my second point here is that it's hard for investors to actually time when they're getting in and when they're getting out. Okay, so with an ETF, you don't have to time your entry or your exit because I would assume that you plan to hold it for about 20 or 30 years, all right? So you actually have to get two things right. You have to get your entry rate at a good price, and you have to exit at a good price to where you're making money. And with an ETF, you just don't have to do that because every stock is included in an ETF because ETFs include many stocks. And that leads me to my next point, which is diversification. So I have pulled up here a map of the S&P 500 and all of its current holdings. So only a small percentage is allocated to each stock, and it's based off of market cap. All right, so Apple, the biggest company in the United States, it's going to be assigned the largest percent. I think it's like 6 or 7 right now. But you pretty much get exposure to the biggest companies in the United States. So we got all these different sectors that if one sector goes down, you have all the other ones to make up for it. If they all go down, like in a recession, you could have, energy that makes up for it. So it's better than just holding individual stocks. So basically, you just have all these stocks to lean back on if one of them goes bankrupt. Okay, so my next point here is that obviously when you're wanting to buy a stock, you're going to have to do some research on it, which does require a lot of time and effort that you wouldn't need to do if you were to just buy an ETF that contains that stock. So let's see what you gotta first do. You gotta see if the company's profitable. Check out the financial papers. Check out the past history of the stock. You gotta continuously monitor it and check back every week just to make sure everything is going according to plan. And just listen to what other people have to say about it. So it can be pretty tedious, I would say, which most people I feel like don't have the time for, unless you're me and like doing this stuff. I'm not most people, I guess. So my last point here is that some stocks that you may be buying have smaller market caps, and because of that, they're more likely to have volatility, which I feel like most people do not want in their portfolios. And the reason this is because of how small they are, and the amount of money going in and out of them has bigger effects on their price action. So for example, a $100 million stock that just got $10 million pumped into it, that would be a pretty big move. That would be a 10% move up, or it could go the other way as well. But if $10 million went into Apple, which is a multi-trillion-dollar company, you wouldn't really see an effect there. You would pretty much see nothing. So that's just something to pay attention to. Okay, so I've talked about all the reasons of why owning individual stocks is not the best move for inexperienced investors. So I'll talk about some good reasons why to hold individual stocks now. So first up, we got pretty much if you just feel overall confident in a company's perspectives, it has a bright future after looking at the balance sheet and all that good stuff. You determine that it's a good hold. I'd say go ahead and maybe allocate a small percentage of your portfolio to it. Similar to how we have here with SPY making up, or will be making up most of my portfolio. I have smaller percentages in Coca-Cola, Tesla, and all just good stocks that I believe in the long term. Alright, so for my next reason of why it might be a good idea to hold individual stocks is because it's a way to actually avoid management fees associated with ETFs. Usually it's like a 0.03%, and in the long run, that 0.03% associated with SPY or VOO could make a difference in the long term by about a couple percent of your overall money that you get in the end. So it's just something to think about. Maybe you make your own ETF out of individual stocks, but that might be difficult because you have to rebalance it every so often, and I don't know. Probably don't do that, but alright. Next reason here is it's a way to stay motivated. So it's actually an interesting one because, at least for me, when I'm buying individual stocks, it makes me feel like I'm actually taking part in the company. Whereas with owning just a broad index fund, it doesn't have that a coolness factor to it as with owning an actual share of a company. Because when you're buying an ETF, the fund managers actually they buy the individual stocks. You're buying the fund. You're not actually buying individual stocks. You're just buying the fund that tracks the stocks. I don't know. It's just a cool way to stay motivated, make you feel like you're actually a part of a company. And that's pretty much all my reasons here. So, all right. And I'll see you next time. Peace out.